Great. Good morning, everyone, and thank you for joining us. My name is Sean Horrigan. I'm a Marketing Communications Associate with Commonwealth Purchasing Group. For those of you who are unfamiliar with our program, we are the leading group purchasing organization for community health centers and other nonprofit organizations. I encourage you to visit our website at cwpurchasing.com to learn more about how we can help your organization save money. Today, we are very excited to have Paul E. Clark, National Healthcare Captive Practice Leader and Managing Partner at Clark & Levy Benefit Solutions, a Hilb Group company, to discuss introduction to InCap for CPG members, the true turnkey healthcare captive solution. Before we begin, let me tell you a little bit about Hilb Group, then I will introduce our presenter. The Hilb Group has had the honor of being the endorsed insurance broker of Commonwealth Purchasing Group for 25 years. Hilb Group is a leading employee benefits and property and casualty insurance brokerage and advisory firm. The Hilb Group has over 2,000 employees with 100 plus locations in 22 states and service to all 50 states. Hilb Group offers access to the resources of a national company while also maintaining a local team and personal relationships. The Hilb Group is a top 15 U.S. insurance agency and a 5,000 fastest growing company, featuring centralized shared services, regional leadership and support, and local community presence. Their established team of experts, combined with their rapid growth, allows them to provide a strong core of resources while constantly enhancing their capabilities to build, expand, and innovate to meet the future needs of clients. Now let me introduce our presenter. Paul E. Clark founded Clark & Levy Benefit Solution in 1997 after a successful career with Blue Cross and Blue Shield of Massachusetts. It was a privately held, family-held firm for 25 years until Paul decided to become part of the Hilb family. He has retained his role as a lead consultant and managing partner of Clark & Levy and is the National Healthcare Captive Practice Leader for all of the Hilb Group. He has been in the industry for more than 30 years and is widely regarded as a leader in the captive market space. He is a member of the National Association of Health Underwriters, the National Association of Insurance and Financial Advisors, and International Foundation of Employee Benefit Plans. Today's webinar is designed to last for 1 hour, give or take, allowing 30 minutes for the presentation or 40 minutes for the presentation and another 15 minutes for Q&A. If you have a question, please type it into the Q&A box and I will share it with Paul directly at the end of the presentation. At this time, I'd like to hand it over to Paul. Thank you for being with us today, Paul. Why don't we get started?
Well, thank you very much, Sean. Before we jump in, I just wanted to introduce a couple of other folks who are on the call. And I know that a number of you have probably spoken with either John or Jonathan Siracusa, also part of our Hilb group of family products. And they're spearheading a lot of the activities throughout your organizations and communications with also a member of our group, Noreen Chick, who's in our offices as well. And they'll be reaching out to you at some point in time and trying to set up a meeting if you're interested in what you hear today. And probably the two most important people to thank are Samantha and Deidre from both of our offices, the CPG group in our office, for getting this all set up and making this as easy as possible. And Sean, thank you as well. We very much appreciate your assistance here. And what we planned on doing today is giving you a very brief, or as we refer to it, as the Captive 101 overview. A number of you across the nation have really been seeking alternative arrangements to the standard premium or level funded options because they're just not working. The rates of increases are too high. And the companies are really deciding to take more control over their own benefit structures. And as I'm fond of saying, taking back their money and deploying those resources for their benefits, their group's operational efficiencies to help their employees, et cetera, et cetera. So this is designed to be very brief, very short. We'll go fairly quickly through some of the slides. But what we're hoping to do is give you the basis of what the captive works and how InCap in particular works. For any of you that are interested, as Sean said, please submit questions. We'll address questions at the end. We've saved a few minutes at the end. And then again, we're more than happy to set up individual meetings with each and every one of you to review the full-blown capacity of how captive works and why InCap offers many different solutions that others don't. So without further ado, we'll just start going through some of the slides here. And the very first slide, thank you. Very first slide, it really, what's a group captive? And what I usually tell people is, best way to think about it is, it's a purchasing pool. The more numbers you have to purchase or to negotiate with, the lower the rate is for all. Same concept, same actual, methodologies of, all right, how are we going to break apart the individual components to be able to provide a lower cost structure to each of the members. We've been very successful at that, and we now have over 140,000 members in the total captive pool to be able to negotiate on your behalf. The next slide that you'll see is a little bit of some of the meat and bones of a captive. Who is right for a captive? Now, this isn't cast in stone, but the basic rules of thumb are, and this is because each state has their own rules and regulations to certain elements of healthcare funding. But the base is here, what you see, middle market, from employers that have 50 employees enrolled up to about 2,000 employees enrolled. That is really kind of what we call the middle market. Now, we do have some employers, depending upon the state that you're in. We can have, a few that are lower than the 50. And that really depends, again, on the state. And the example that I typically use is the state of New York is very restrictive. And the state of New York, it's actually 100 or more. They will not even allow you to enroll in a captive structure if you're under that number. Looking at the areas of people who are on the call today, Sean and Samantha were very helpful in giving us an overview of where a lot of the folks who are on the web call today are. I don't see that we have anyone from New York. I know that we've got at least one or two from New Jersey, but anyway, that's the basis of how, if I'm going to be interested in this possible solution, what should I be thinking about? Next slide, please. This is basically a question we get all the time, because a lot of folks, when they're starting to evaluate their process, they say, we've been in a premium space, we've been doing it this way, we're tired of playing the old whack-a-mole game with the carriers, but if I self-fund, what's the difference between self-funding on my own and with a captive? And that goes back to the earlier point I made about the size of scale of the negotiating power. When you self-fund on your own, you have those same influxes of, you had a really bad claims year, so you're going to get a really big increase in stop loss, or one of the elements of protection within the captive. Same as it is on a premium basis. When you're in a captive structure, there are a number of elements of shared risk or shared elements in the fiscal components that brings the rates down and has a very positive effect. So you have a bad claims year, which you're going to. This is health insurance, this isn't widgets. And for the majority of companies out there, every 3 to 5 years, you're going to have a rougher claims experience year because, again, health insurance, not widgets. So the main difference between why should I go to a captive health plan versus a self-funded health plan is we've got the law of large numbers working together, and we're pooling the numbers to be able to bring the rates down for everyone. And that really is a critical difference. There are many other elements within the captive structure. We probably won't be able to get there today. That's captive 201 or 301, but it's a good overview to understand. The next chart basically just talks about a couple of critical elements within the self-funding of a captive structure. One of the core differences that we offer in InCap, and by the way, InCap is a trademarked Hilb-owned product. You have a couple of pieces to self-funding that are critical to making it what we refer to, and this isn't technically correct, as a fully insured, self-insured plan. One of which is this first gray box that you see here. Each employer decides the level of specific stop loss or the amount per claimant that they're going to be funding before some of the stop loss coverages kick in. One of the core differences that we offer, a lot of other healthcare captives, they come out and say, you have to have X. They don't let you choose. What we do is we've made a very conscious decision to allow for the best option for each client. Each client is different. We have groups in Connecticut that have 300 lives. They want a $75,000 specific stop loss. We have a group in Missouri. They're only 120 lives. They want a $25,000 stop loss or a specific stop loss. So we have flexibility there. Then what happens is the claims between the specific stop loss level and the aggregate attachment point. Now that's not technically correct, but for our conversation here, that $500,000 mark, anything over $500,000, any claim is reinsured off. As a good insurance company and a good, monitor of the fiscal elements going on, any claim that's over 500,000, we reinsure off. So the captive isn't taking, huge losses. That is also something that is very different than others. They have different levels. We think this is the appropriate level, and it really has provided us with the past 10 years of profit shares, which is one of the key items that you're all going to want to hear about, because that's something that we've been very successful with for the past 10 years. The last item you see there, that shifting of the claims, it kind of ties into the second element, but it basically is a way of us protecting the captive, because what we're trying to do is accumulate the monies in the shared layers that when there is money left over, you, the member, get a profit share of that. So as an example, the last profit share year, $15 million went into that layer. $10 million was paid out in claims, and that's the entirety of the pool. And the remainder of that $5 million was profit shared back to the members, i.e. you, in total. There's no part of that element that we maintain. There's no part of that that the TPA maintains. It is completely a structure where the monies are going back to you to be deployed how you see fit. So again, a little bit of an overview there. And this next page that you'll see is extremely important. This is what we refer to as the secret sauce, the layer cake. And here is really where it all works. So I'll spend a minute or two here. And again, I'm sure we'll have some questions on this. One of the things I always challenge people with is, does this look familiar to you? And for the majority of people, they answer no. And I would retort, it should, because this is what your current premium and or level funded carriers are doing. They're just not showing you how it's done. We want you to know this. We want you to be engaged. That's a very important element of our process, and I'll explain how this works. So you remember we talked about the amount of claims dollars that the employer is funding up to that $25,000. I'm going to stick with that example. So you're funding the $2 claims, the $10 claims, the $30 claims, the $5,000, $10,000, up to $25,000. All right, and this is the same way that your current scenario is. No one's just explained it to you in this manner. Then the money that you are putting into the risk sharing or the captive loss fund, the shared layer that we refer to, all of the participants, every single InCap member is putting their stop loss dollars, the specific stop loss dollars, into this layer. That was the example of 15 million went in, 10 million was paid out, 5 million was profit shared back to the owners, i.e. you. So that's a very important element. Another piece that's really important, you'll see this collateral reserves, and that's something that we also do very differently. A number of other organizations out there, what they do is they commingle this fund with your reserves. We do not. We come up with that number. It's approximately 10% of the specific stop loss annual cost, and it is held completely in reserve. There's also another element of this layer that's very important for you. What a lot of other companies, healthcare captives do is they say, okay, we'll allow you to come in. You'll have to take these levels of stop loss, but until you've been a member for 3 years, we won't allow you to share in the profit shares. We allow you to do it in the very first year from once you join. The other piece here is they'll say, okay, we're looking at the collateral reserves and the shared layer fund. And unless you've been in for 3 years now, but also unless you're profitable, you don't get profit shares. We also disagree with that methodology. Going back to what I said earlier, we know that every 3 to 5 years, you're going to have, the old bell curves we learned in high school. So we maximize the potential benefit for all members because what we're trying to do is get everyone on that same path, or using a quote from a famous movie, getting all of our ships sailing in the same direction. And you should benefit when it's good and pay more when it's bad. That's our whole stance or methodology that we employ. And we're one of the only captives out there that has been profitable and providing profit shares for the last 10 years. It's actually been longer than that, but I like to stick with smaller numbers. The last layer, as I mentioned earlier, any claim that's over $500,000 is layered off or reinsured to protect the overall captive structure and, quite frankly, to protect your profit shares. So this is really the secret sauce. Now, when you get your premium numbers, let's just say, and I know this is probably a ridiculous example, but you get an individual premium of $250 and a family premium of $500. All of these elements are baked into those numbers already. What we find in the marketplace is sometimes, wait a minute, we're going to be funding $25,000 of each claim. Yes, that's already been taken into account. So again, if you're interested, we'll be able to explain this in much more detail, and we'll actually show you what we call premium rates in the premium market space. The equivalent are called working rates in the self-funded arena, and we'll show you exactly how it works to take that, unknown entity or element out of it. Next 2 slides are really important, and I'll go through a couple of elements. One of the key differences that really distinguishes us is when we looked at the captive market space, the healthcare market space, we looked at it and we said, a lot of these organizations are out there offering what they call a turnkey solution. But what they were really providing was just the actuarial services. We took a very different approach. We analyzed the whole structure, and we said there are really 2 key departments, for lack of a better way of saying it, that really need a lot of extra attention here because they're doing all the heavy lifting: finance and HR. So what we did is we developed and we added to the actuarial services, which, by the way, the actuary in this example is our company Roundstone here, a partner. They are the actuary. But then if you look at all of the services you'll see under the Hilb group, we added a tremendous amount of HR related services to help deal with the issues that our HR practitioners are dealing with every day. And trust me, for the folks who aren't an HR practitioner, there are many. Okay, so we've added in a number of those services. I won't really get into them in detail today, but more than happy to. In addition, if you look at under the TPA services, we've added in elements to our program that no one else does. One of the key items is, if you look about midway through this page, you'll see claims fiduciary responsibility included. One of the biggest downsides of self-funding is when you self-fund, you become the fiduciary. That has a legal and technical implications to it. In our InCap program, we have in writing contractually, and you will have that as well, that the third-party administrator takes on the claims fiduciary responsibility. That is a huge liability that we have taken off of the plate for you. Again, more than happy to go into that in detail if you're interested. The other piece that's really important is if you look at the last block down the bottom, you're going to see the individual concierge program. This is exactly what it sounds like. We looked at it and we said our HR people are being barraged with different questions. A lot of the times it's medical questions or prescription drug questions, someone who has just been told they need a surgery, et cetera, et cetera. So this individual concierge program provides each and every one of your employees an individual medical concierge. Now, that could be a primary doctor, an OB, a specialist, a pharmacist, a surgical specialist. I've been told I have to have this surgery. I'm concerned. I don't know the right questions to be asking of my specialist. So each person gets an individual concierge that they're available to assist them and talk with them directly. Next column you see is our PBM. Now, there were a couple of key elements here that are really important. I think you've probably all heard, throughout the United States, the amount of money that the prescription drug manufacturers lobby Congress with is immense. They are the single largest lobby. The PBMs, prescription benefit manager companies, Southern Scripts is one of those. There are many of them and they're varying. One of the key elements of the Southern Scripts program is this, though, the very top line item. It's what we call a complete pass-through PBM. In other words, all of those rebates or bonus programs that the drug manufacturers are paying out to the PBMs and sometimes the TPAs and the consultants go directly to you. Not a penny goes to us, not a penny goes to the actuary, not a penny goes to the TPA. It all goes back to you, the client. Now, as an example, we have, and it can be significant. It depends on your utilization, all right? But I'll give you an example of one of our clients down in Connecticut. They're 315 lives. Last year, their annual PBM rebate was $120,000. It can be extremely significant, especially given that the majority of drugs that are being prescribed for what I'll call, the A cases, high cost claimants, are specialty drugs. The specialty drug marketplace is outpacing medical inflation. So this is a really wonderful program. We have saved our clients a tremendous amount of money. And we also have the international mail order drug. And the other one I like to point out is the variable copay plan. When you see those commercials and they say manufacturer's assistance might be available, they make it seem like you have to jump through a million hoops to get that manufacturer's assistance. It's anything farther from the truth. There is a list of about 256 drugs. When you come onto the InCap program or your employees come on and they're taking a medication that's on that list, Southern Scripts automatically applies for the coupon on your employees' behalf, but it has a double effect. Reduces their cost, but it also reduces you, the employer, cost. So there are a number of different elements we have included there. Again, we'll go into a lot of detail, or as much detail as you allow us when the time is right. The next page, I'm going to only really talk about two elements here. The HRK is another Hilb-owned organization. They're one of the leading HR resource organizations in the United States. They have a plethora of different services that they offer. All of the services that you see included under this column here are included in the InCap services, no additional cost. We've built it in. The last two pieces, we have a great resource called Engage. This is a product that really helps people find services at a lower cost. Now, up in this area, if you get sent to a hospital for an MRI, it's probably going to run about $5,000 or $6,000. But right down the road, there's a group called Shields MRI that does the exact same service. And you'll hear some of the MRI, oh, it's different. No, it's not. It's not different. Now, there can be differences depending upon someone's condition, but this service helps people find the other services. It will cancel the old schedule or the old provider and schedule the new provider. And we give your employees a portion of the savings to encourage them to be good consumers. Last column is the wellness program. We have a wellness solution. We used to mandate that it be part of the program. We no longer need to because we have developed a program that we refer to as control the controllables that has really brought down the claims exposure and the medical loss ratios to a very significant degree. So for the clients that do want a true wellness program, we have a wonderful program. They're based out of Utah. I'm more than happy to talk to you, at length about that. So those are some of the elements that are in the program. And then the next page really is just a short illustration for those that have an actuarial or underwriting mind. I mentioned something earlier when we first started about how do we getting this benefit? How are we beating the national TPAs at their own game? Well, this chart's basically a visualization of when you're a 50 life group, the chances of you have a large claim that the insurance company takes large losses on you is higher. As you go, in this case, down the chart and hit 400 lives, you become more attainable, you become more accurate, or what they refer to in the underwriting departments as credible, i.e. they can predict for a group of 400 lives, you're going to have 3 cancers, 5 pregnancies, et cetera, et cetera, et cetera. They just can't tell you who, okay? But it is really interesting how accurate they can be. It goes back to my example at the beginning of the law of large numbers. We have 140,000 total in the pool. It allows us to really share resources in the key elements that we've already discussed to bring the cost down for all. So that's what this chart is really illustrating. The next chart that you'll see, again, it just further goes into what else is really involved in the captive. Well, transparency. You're going to see every single element. We have quarterly meetings with each of our InCap participants. Now, obviously, we don't provide the names. We show the data. Here's what's going on in your inpatient, your day surgery, your prescription drug program. Here are some of the elements that can be controlled. For those of you that are providers, we can also provide steerage. We can help you as we have. In fact, John Syracuse might talk about it towards the end. We just brought on someone in the Nevada area and we developed for them because they were a health center where, look, your health center offers these services. We can have people come to your facility, lesser cost. It's a different write-off structure for you folks. We know we're not going to get everyone because, Paul's not going to go to Dr. A that Paul works for, but it still offers a better way to deliver services and provides lower cost overall for the employee, those that are willing, and for the employer. The control elements. You are able to control the plan design. Obviously, that's going to be a big portion of what we're doing for you. We're going to be looking at the plan design, looking at the claims experience. No more of this, well, you're getting a high rate of increase because we told you so. No, this is a trust but verify system. Each quarter, we're going to be looking at what's occurring, and we're going to be making recommendations to you at that 9th or the 3rd quarter, at the end of the 9th month, saying, look, we're seeing these trends. Here are the elements we think you should, lower this copay, raise that copay, et cetera, et cetera. We talked a little bit about the pharmacy benefit management in the last slide, so I won't go too much into that. The cost, again, talks a little bit to the aggregated purchasing power, but I will throw out a statistic that I think is pretty important. We haven't seen an increase. Now, this is the entire InCap grouping. The highest increase we had overall was 12%. And that was on a customer that had about a 4.0 loss ratio. The average rate of increase, and we just got these numbers in for the last year, was 9% overall. Last year it was 5%. The numbers are starting to eke up a little bit, as you probably are all seeing, because now that the pandemic has waned to a degree and people are going back to using more services. But we are far below the 20 and 30% issues that some of you have seen, and we're kind of a standard. And we'll never get up to that point, at least not in our structure. We're very, very proud of that. And that does not take into the account that we've returned over $71 million back to our clients. Again, the turnkey piece is what I was putting all of these pieces together with our partners. And that's something I think is also very important. We refer to the people that we were showing on that turnkey solutions page as partners. We have contractual relations with them. They're not vendors that change each year. We've had a very successful run with them, and we think you'll agree once you see the full details of it. Next page really talks about some of the core differences. This is really for folks who've never seen, a self-funded program, or, what's really the difference. Okay, I won't get too much into the weeds of this, but it really is, it's a basis of saying, look, here are the fixed elements that we know you're going to have to pay. But then there's some variability in claims costs. Why don't you get benefit by joining a captive, a healthcare captive, when there's variability, when it works in your favor? You're in a fully insured market, you're paying that premium every month, whether you use it or not. It goes to fund their organizations, not yours. So we reverse that trend. Again, more than happy to go through as many of the elements that you would like. Then the question that's always asked on the next slide is, how does it work? And really what we decided to do, we like to give testimonials, or we like to, as the saying goes, proof in the pudding. Here are some testimonials from folks that have been in the program for quite a while. Actually, one of them is brand new. They just came in last year, and they're enjoying it so much that they decided to give us a testimonial as well. We have had a fantastic run with this. The only clients that we have lost in this structure are the companies that have been bought out, or we've had a couple that actually went out of business. We have a ridiculously high retention rate, and we believe it's because the companies that have come into InCap have realized the savings. Obviously, that has to be there, but they've also seen that what we've talked about, what we've promised, we're delivering on. It's one of the reasons we have quarterly meetings with you. 1 hour quarterly meeting to review the financials, so that you and your organization, and depending on your board or reporting structure, you have the data based upon what your clients or your employees are doing, so that you know what is occurring throughout the year, not just at renewal time. We also think that's a major flaw in the marketplace. But we're very proud of these. And then the next 2 pages, these are some of our results. The next slide really goes right to it. 77 million in savings. Our profit shares have been record breaking. Again, I think that the profit shares, when someone asks me, Paul, I know last year you had a 22, a 17, average of 15. What we tell people is you should expect between an 8 to 10% profit share per year. Now, last 3 years, like I said, have been much higher, but I think that's been a little bit of the COVID. Some of the claims were coming down, or people weren't going for services. We're starting to see that come back up. But one of the stats that we're extremely proud of is we're running 25% lower than the national TPA's medical loss ratios. Part of our the controllable program really has worked, and it's really been based on, number one, the metrics itself, but also from the engagement with our clients and feedback, being able to have those open and honest conversations with you and say, look, here are the elements that are driving your costs. Here are the things we think you should work on. You might say yes to 1 and 2, but no to 3 and 4. Perfect. We're starting to, be able to make decisions on actual metrics. The next page again shares a little bit of some of the other elements in that, we have an InCap University to train our people on the elements that are coming up and changing, because as you all know, this is an ever-changing industry. I don't think we've sat still for the past 15 years. But those are some of the elements that we have, provided and produced within the InCap product. The next page is something that we think is extremely important, because this is one of the key differentiators. We spent a great deal of time when we were sitting down and evaluating the actuarial / underwriting firms. Roundstone has been 97.5% accurate over the last 10 years plus. That is a phenomenal statistic. We can explain this chart a little bit more. It's what we call the scattergun chart, but basically how many numbers that they projected hit the projections or below. Yes, there are occasionally some groups that go above, but the majority of them are below, and they are extremely accurate to what they do. One of the biggest rubs on self-funding is, these groups come in and they give us a number that had nothing to do with reality, or they only gave us 9 months of claims. All of our projections are based on a full 12 months of claims, and them being 97% accurate is really a fantastic number. Next slide or two, you'll see some of the pool information. One of the elements that we learned early on, having just one type of risk, i.e. we started out with just nonprofit organizations, and we learned that the risk was too concentrated. So as things started to expand, we learned some of our lessons. We've been doing this for a long, long time now, but you'll notice there's a wealth of different type of organizations, or in underwriting speak, there's a wealth of different types of risk, which really allows for that overall basis to create a profit scenario to be very positive. When we first started the program, you could only come in either one of the two pools, the January or July pool. We've now expanded that where you can come in at any anniversary date. And I'm sure John and Jonathan and Noreen are more than happy to talk to you about how that would work for each of you. But the next one is, I'm sorry, there's the July pool. Thank you, Smith. So the two pools combined is where I got my total numbers. And we're waiting on the total numbers from this past January's enrollment. And I can tell you we had a 30% growth margin in it because companies are just tired of that old, I referred to it earlier in the conversation, the whack-a-mole game. And I know I'm probably dating myself because there are probably a number of you on the phone who don't even know what whack-a-mole is, but it was that old game where the thing would pop up and you'd knock it on the head and get it down. And it really is, for lack of a better way, a game with some of these insurance carriers. We've taken those elements out. I'll be more than happy to discuss. There are 5 or 6 key elements that we've taken out of this process to give you back control. But again, we're trying to illustrate the types of groups that are involved. The next page is also important. It shows you the trends, okay? If you're on a fully insured marketplace, those are the types of trends and rates of increase. Pretty big difference here. We're more than happy to show you exactly how we're doing it. And it's, one of the other things people ask is retention rate. You heard me say earlier, we've only lost clients that have basically either been, merged through merger and acquisition, or a couple that went out of business. We're very proud of that. So our trend is running in the right direction. And then a lot of folks, they typically, okay, well, who do they have? The core element that a lot of our HR practitioners are asking about is what networks do we have? We're using the national networks for administrative services. So we're renting the Cigna National Network, the United National Network, the Aetna National Network. And it does vary by region. In some of the areas like Missouri, they have HealthLink, all right? We've got access to HealthLink. Down in Florida, it's Aetna, and in some of the others. Down in Texas, it's Aetna and Cigna. Up in the Northeast, it's more the United / Blue Cross or Anthem networks. So we have a lot of reach and scope. We've really taken a lot of time to provide services to all the eligible employers and provide their employees a good network matchup. Matter of fact, we will actually even provide or perform a network matchup for you. So if you get us your current listing of where your employees are going, which doctors, primary specialists, OBs, et cetera, we can actually get you a complete matchup saying 98.5% of the doctors that your people are currently using are in the network that we're proposing. So that, John, I don't know if you'd like to jump in on a couple of things, if I've missed anything for our folks here at the CPG group.
Paul, I think you did a great job, and thank you for that presentation, and thank you everyone for listening. I think we're going to open it up for questions and comments. I think that, obviously, one of the questions that we get from a lot of our clients working in the business for many, many years is how do I become part of a bigger organization to level my costs and to become more predictable and to be more competitive? And this really is the program to do this, because as Paul had mentioned, there's over 130,000 employees in this program. So you're really becoming part of a profit share pool of 130,000 employees instead of your normal, if you're an average size of 150 or 200. So it's very powerful. It's worked very well. It is a proprietary product. So by being a member of the Commonwealth Purchasing Group, you have the exclusive availability to be able to have this product available to you. This isn't available just in the marketplace like any other program that you might have. And with that said, the best way to really look at this is to just do an analysis. You know, and then once the analysis is done, we can very quickly recognize whether this might be something that might be of further interest of you for you. It may actually be a really nice solution. Paul, I'm not sure whether you talked about any steerage, but
just briefly, yeah, no, that's a
Okay.
great point, but especially because we've got a number of provider groups on the phone. You know, we have been working with the medical provider community for a long, long time. And the ability that you have, I mean, obviously a manufacturing facility can't have people come and receive health services there. You as a provider have a lot of ability to direct or create what we call, and John just mentioned, a steerage network. So short version is, all right, if you come to our facility, instead of having a $25 copay, it's going to be a $15 copay or a $10 copay, and or we'll give you no deductible. But if you go outside the network or you go to one of the other providers, you'll be subject to your normal copay and deductible. We've been very successful with that and saved, one of our hospitals has actually saved over a couple $1 million over the past couple of years on it. It's really, really beneficial because you have an advantage that no one else out there does. So I'm more than happy to talk to you about that, and we can show you examples of exactly how we work it up for you.
Okay, why don't we, I know that there's at least one question. Why don't we have the questions and answers? I think we've got one on the board here. Let me read that. It says, can we do an analysis off our census? I don't have loss history. We are starting open enrollment on the 1st. Is it too late for us? If not, maybe next year.
So if you mean the 1st of April, that would be a little quick. But what typically we will do for folks like yourselves is we look at an analysis for say 7-1. All right. Depending upon the structure you're in right now, or a 1-1. So it's really never too late. And I think part A of your question is really good because a lot of companies are, you know, they say, geez, I've heard if we're going to get into a structure like this, we have to have, you know, 10 million years of claims experience. And that's not really accurate. Now, if you're a large group, you're over 100 lives. And again, depending upon the state, I'm being a little bit generic to not, you know, because each state has a little differences. But if you're in an organization that has claims experience, yes, we want to get that. And we need to get 2 years or 3 years of data. But if you're in an organization that doesn't, the way that we get around that is we get your past 2 to 3 years rates histories. And people say, well, why would you do that? Well, I'll use this as an example. If I get a 5% increase, 5% increase, a 30% increase, what can we assume happened in that third year? Now, a lot of people say, oh, so I'm not a good candidate. No, actually, you're probably a very good candidate because if you remember those old bell curves, you know, what happens? You're good, 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 all right, bad, and then it comes down. So a lot of the clients that have come into our captive were having bad claims years, and they also took the extra time to say, hey, would you guys, you know, look at the claims experience? We paid X out with the current carrier. What would the same claims cost have been under your program? And they realized how much really the premium carriers were adding in for fudge factor that we don't do. And it was really eye-opening. The one that I use is a real example. This is a real client. Obviously, I can't mention the name of them. We had a provider up in our area that was trying to bill over $600,000 for a chemo treatment. Well, come to find out, this chemo treatment wasn't occurring at the facility. It was a home delivery, home injection. And after getting through with reviewing the claims data, we got it down to the appropriate payment schedule, which was 150,000. That's a pretty big difference. Okay, especially when you're paying the bill. And more importantly for you, if we didn't scrub that, we're really into scrubbing claims for proper payment. We're not trying to hurt the provider community, and we're very sensitive to your needs and issues. But if we get that payment down and scrubbed properly, we're basically reducing the spend by you, the employer, and your employees. That also affects your renewals. Okay. We have a number of different illustrative charts that we can show you. Again, we're trying to be very kind of 101 today. We could go really deep. We can show you examples of the quarterly claims reviews. We can show you examples of what we call the loss ratio reports. As an example, one of my clients, it's up here in the New England region, they're about 220 lives or so, and annually they get billed about $7.5 million in charges. And after we're done scrubbing the claims and making sure proper payments are made, it brings it down to about 2.5 to 3 million. That's a pretty big variance, folks. And yes, that's what's been occurring in the marketplace, which is a big element of why your rates are going through the roof. We do not allow that. We scrub those very diligently.
Well, thanks for that, Paul. And with that individual that asked about that, we will reach out directly with you if that's okay, and we can talk about your particulars, whether it would make sense at this point to do analysis. There is another question that has come up. Will this recording be sent to those who signed up to attend? I believe the answer is yes to that, but I believe I'm going to defer that to someone else.
Yeah, I think we'd defer that to Samantha and Sean.
Yes, I will be sending this out at the latest tomorrow.
Excellent. Any other questions? Okay. Well, we appreciate it. We know you folks are very, very busy. We appreciate you affording Hilb and us this time. Like I said, through Sean and Samantha, John and Jonathan and Noreen will be reaching out to those of you that are interested. More than happy to do a complete webinar for your organization solely. If a number of other of you would like to get together and have one larger one that we could schedule a 90-minute, we can go a little bit deeper. But we do have a lot of examples. And, one of the things that we were talking about is one of the questions that typically comes from, your type of organization is, well, how many other medical practitioners do you have? And we've got groups ranging from, 50 lives up to 1,500, but Compass Medical, Harbor Health, Health Imperatives, Latham Centers, High Point Treatment. You already saw Community Health Alliance, Constellations Behavior. I mean, those are just to name a few. Okay. We have a lot of experience with the provider community. And I think that I'll say it like this. I think your eyes will be opened when we show you what we can do for you, especially given the fact that a great many of you have an advantage in the marketplace that manufacturers or other organizations just don't have. So, Sean, again, thank you to yourself and Samantha very much for setting this up. We very much appreciate it. And if your folks have any need for any follow-up, please, I know John and Jonathan will make sure they're following up with you, and just let us know what we can do to help you. And we'd love to talk to you more about InCap.
Thank you so much, Paul, and thank you, John and Jonathan, and thank you everyone who joined us today. We're really thrilled that you took the time to be part of this webinar. And as Samantha mentioned, you will be receiving a recording of the webinar by tomorrow. And this webinar will also be archived on the CPG website, so folks can access it there at any time. And please, if you have any questions in the meantime, email us here at CPG. We're always happy to help you as well. So thank you, everyone, and have a great rest.